Most people think bull and bear markets are obvious. Prices go up, it's a bull. Prices go down, it's a bear. But in reality, it's rarely that simple. Because markets don't flip like a light switch. They're more like a dimmer, gradually shifting from one mood to another. By the time everyone agrees which animal is in charge, the biggest price moves have usually already happened. Besides the broader direction of price, what separates bull and bear markets is the general sentiment and environment around it. In bull markets, risk-taking often feels rewarded. Dips feel buyable, pullbacks are temporary, even healthy. Bad news gets shrugged off, while liquidity is abundant as new money enters more confidently. In a bear market, risk feels punished. Rallies lose momentum and get sold off, and even genuinely positive developments struggle to lift sentiment. Liquidity is tighter, and forced selling becomes more common. Traditional markets sometimes rely on simple rules of thumb. If a major stock index has dropped about 20% from a recent peak, it's often considered a bear market. Even then, these are mostly convenient models, as market cycles don't exactly adhere to clean boundaries. Crypto, being much more volatile, makes this messiness even trickier to navigate. A 20% swing can easily happen in a week, or even a day. Bear markets can have violent relief rallies that briefly reignite hope, and bull markets can suffer pullbacks that feel like the end, right before prices push to new highs. This volatility makes trends feel far less orderly, especially when zoomed in, which is why the transition is a bit like musical chairs. For a while, everything feels normal. People keep moving, assuming the music won't stop. Then, suddenly it does, and everyone scrambles for a seat. But there aren't enough to go around. This, of course, doesn't stop people from drawing lines in the sand to call the cycle and help them navigate markets as best they can. Some swear by the 4-year cycle theory, on-chain indicators, technical indicators like moving averages, volume, or RSI. These can be useful clues. But no model or analyst is a crystal ball, so it's probably wise to not base all your financial decisions on any particular one. It's also worth remembering that your personal time frame matters. What can be a fearful, anxiety-filled downturn for a short-term trader could be a mere blip for someone with a 10-year hodl strategy. And this brings us to the bigger question: why are bull and bear markets even a thing? Because markets are made of people. And as unique as we may feel as individuals, collectively we tend to be surprisingly predictable. We get excited when prices go up, get swept up in euphoria, and then bear markets smack us back down to reality. Weak hands get shaken out, and prices return closer to their fair value. But this creates the ideal environment where the seeds for the next bull are planted, where hopefully real, useful innovations are born, fueling the next run. And so the cycle continues. Every bull market creates the excess that leads to a bear, and every bear lays the foundation for the next bull. The question isn't if another market shift will come, it's when, and whether you'll be ready for it. If you're waiting for a headline to tell you the bull market is back, you're probably already late to the party. Watch this video next on the Crypto Fear and Greed Index for another way to read the market.